In trading, there are no shortcuts. You have to learn through years of experience, thousands of hours of screen time, and put in a ton of work. That said, if you're to consider one tool a cheat code in the markets, it's this. Today, my friends, we are looking at Delta, your second pair of eyes when trading. Delta is the net difference between the market buys and the market sells at either any particular price point or within a candle. Knowing this information can give us critical insights into where the market will reverse. To understand Delta, we need to focus on the relationship between market and limit orders. Think about these two order types in very simple terms. Market orders are what makes price move, and limit orders are what makes price stall or pivot. As you can see here, market buy orders are taking place, pushing price up until they hit a wall of sell-side limit orders, in other words, asks, and when they do so, they run out of steam as there simply aren't enough market buys to continue and price starts to reverse. This is what's known as absorption, where market orders, whether buys or sells, are absorbed by limit orders to the point that the market participants are exhausted and price reverts. The key in spotting absorption is simple. We are looking for high delta to be produced whilst price slows down or stalls. This shows us two things. Number one, that markets have moved into limits, and number two, that markets are running out of energy as they do so. Knowing where absorption takes place in the market is incredibly useful, as many of the tools you've learnt so far in the series are used for reversals, otherwise known as pivots. That said, we have to understand how this tool works in order to utilize it properly. To do so, I'm going to revisit the analogy we used in the sweeps and ranges video, our big guy and little guy. Remember how the big guy operates in limit form as to avoid slippage, and the little guy mainly operates in market form as he doesn't have to worry about slippage? Well, looking at these two market participants again, who do you think shapes the way the market moves? You guessed it, the big guy. Bear in mind when using this term that we don't have to be referring to an individual, it could be an organization or an entity. But whatever the form, the larger influential participants in the market, more often than not, operate in limit form. They are what's known as the stronger hand. In other words, the hand that shapes the market. To picture how this occurs, think of a free-flowing stream. If able to, it would run in a straight line with gravity aiding it. So why doesn't it? Well, because it runs into physical sediment that shapes its direction. This is essentially how market orders work with limits. Markets are the stream, limits are the sediment, and visualizing the dynamics of the market in this way will help you understand the importance of delta and why it's such an essential tool for you as a trader. Now, let's talk about a topic we've covered a bit so far in previous videos: psychological retraining. Instinctually, we would want to see lots of selling at a high and lots of buying at a low, but we need to retrain the way we think about things when looking at delta. Instead, what we want to see is lots of buying at the highs and lots of selling at the lows. So why is this? Well, delta is produced when market orders move into limits. By this nature, if we see lots of positive delta, it means lots of market buying is occurring, yes, but that it's doing so into limit asks. Conversely, if we see lots of negative delta, it means lots of market selling is occurring, but it's doing so into limit bids. As we know, the stronger hand operates in limit form. As a result, which side do you want to be on? The big guys or the little guys? I think you can answer this for yourself, so what we really want to be seeing is lots of positive delta at a high and lots of negative delta at a low, showing us that absorption is taking place so we can hop on the ride with the more influential market participants. Let's take a look at some examples to see what this would look like in action using the concepts we've learned so far in the series. Here we have a nice pocket of intra-demand. As always, we are inclined to join the trend, so we are looking for taps into this zone. If you remember from the supply and demand lesson, demand is where limit bids are resting. So as price moves down into this zone, what we want to see is the production of negative delta as market selling occurs into limit bids. This would work the other way, where we see market buying occurring into supply, which is absorbed by limit asks. Or perhaps we're looking to play a sweep. We see price come out to take a key high or low, and as it does so, it moves into strategically placed limits by larger participants that absorb these market orders, as seen in the sweeps video. What do you think happens here? You guessed it, we get high delta. More absorption means more delta, hence why we are looking for as high positive delta as possible when playing a pivot to the short side, and as high negative delta as possible when playing a pivot to the long side. In terms of how to analyze this data, generally speaking, it can be represented in two formats: horizontally and vertically. Horizontal delta is seen on footprint charts, where we see the delta occur in horizontal form, meaning at certain price points. This can be particularly useful when trying to snipe tight entries, but be aware that the use of footprints is better suited to scalpers. Vertical delta is where the delta is calculated on a candle by candle basis and represented in a classic histogram, similar to how you would view volume. This gives us a more general picture about where absorption takes place, and although not quite as useful in terms of sniping a precise entry, can be a great tool to execute without the noise that sometimes presents itself in the footprints. Vertical delta is also nice as it lends itself to both scalpers and swing traders alike, and where footprints are best interpreted on either lower time frames such as the 1, 5, 15-minute or non-time-based calculations, vertical delta can be reliably interpreted on timeframes such as the hourly. This, combined with the fact that it's very simple in comparison with footprints, makes it a great tool to use in combination with the concepts you've been taught so far. If you'd like to use the templates shown in this video, see the description below for more information. But whatever platform or style of delta you choose to use, make sure it's aggregated delta. This means that the platform you use draws data from multiple exchanges and averages them out for you. In this way, you can make sure that it's a general and reliable picture you are actioning your trades off, and not just the data from one exchange. Delta can be used in many different ways, but the way you should use it to best complement the style you're developing is as a secondary tool to the charts, not a primary tool. What this means is that you should adopt a price action first principle, using delta as heavy backing behind trades that are firstly formed on the charts. For instance, as mentioned earlier, using delta in harmony with reversion principles such as a sweep or swing failure pattern, a tap into liquidity zone, or perhaps a divergence, gives us clear insights into if the market is likely to reverse. In this way, we can use it as our green light, in a sense. Using price action and the charts, we can see concepts form that we believe to be potential points of reversals, but then use the delta to confirm these reversals. What this means is you can take trades with much higher conviction, probability, and subsequently size. It may mean that you are skipping out on trades that don't give you that green light, but in doing so, you will sift out generally poorer trades, increase your win rate, cumulative return, and profitability. So it's time again to look at our old friend, the trend. If in trending conditions, you'll find that pro-trend delta is much more actionable than counter-trend delta. You'll typically need far less pro-trend delta than counter-trend, so bear this in mind when using this tool. Not all delta is created equal. When in a clear uptrend, you will need less negative delta than positive to have an effect. And when in a clear downtrend, less positive delta than negative to have an effect. That being said, this is a rule that's only applicable to trending markets. So when in range-bound conditions, we can treat both positive and negative delta with equal weighting. So we've looked at delta in the sense of reversal trades, but what about continuation trades such as a breakout? Well, in this case, we still want to interpret the data the delta is giving us, but instead of looking for the presence of delta, we are looking for the absence of delta. Let's take a breakout to the highs to illustrate this. When a breakout candle moves up past resistance, what would it mean if high delta was produced? Well, it would mean that as market buyers are pushing the breakout, there are limit asks absorbing the impetus. Not really what we want to see for a sustained breakout. Therefore, when the breakout is occurring, what we really want to see is little significant delta, again giving us that green light, telling us that our breakout theory is much more likely to occur, and that the odds are in our favor for a sustained break as opposed to a sweep or deviation. Just bear in mind that when we break out, it's usually done so with a large impulse candle, and as a result, we will produce some delta. The key here is simply ascertaining if the delta is significant relative to other delta around it. So, whilst it's on our tongue, it's about time we explored these. On to our next lesson, breakouts.